Hello students, I am Aarti Kothawde from lecturer of Bookkeeping and Accountancy from Arihant College of Arts, Commerce and Science, Camp Pune. Today again I am here to explain you in detail the partnership final accounts. In the previous video I have already explained you what is partnership, partnership deed, the contents of partnership deed, the methods of partners capital account, means the fixed capital method, fluctuating capital method, and today the contents of our partnership final accounts are various steps in accounting, partnership final accounts and necessity of preparation of final accounts, meaning and pro forma of trading account, profit and loss account, and the balance sheet. Now see the steps in accounting. Actually, we have already studied in 11th standard journal, ledger, trial balance, and the final accounts. In 11th standard, we studied the final accounts of sole proprietorship, but now we are going to learn the final accounts of partnership. You see the journal. Journal is a primary book of original entry. As soon as the transaction takes place, we first record it in a journal in a chronological order. Then the ledger. Ledger is a secondary book of entry. It is a principal book or computer file for recording and totaling economic transactions measured in terms of a monetary unit of account with debits and credits in separate columns. Third is a trial balance. It is a statement of all debits and credits in a double entry account book. Then the main part is the final accounts. Final accounts gives us an idea about the profitability and financial position of a business to its management, owners, and other interested parties. It comprises trading account, profit and loss account, and the balance sheet. And we must know the final account is prepared at the end of every financial year. Now, what is a financial year? It starts from 1st April and ends to 31st March every year. Now come to the next. Here see how the steps are given. Preparation of journal, subsidiary books, then preparation of ledger, preparation of trial balance considering the adjustments, and then the preparation of final accounts, which consist of trading, profit and loss account, and the balance sheet. Now, before learning the final accounts, we should know why that is necessary to prepare the final accounts. To find out the gross profit or loss incurred during the year. Means the businessman or the partners are doing the business, and if they don't know how much they have incurred a loss or how much they have gained, then they will not understand what is going in the business. So, if we prepare the final accounts, it gives the benefit to all the people that to know the gross profit or gross loss, net profit or net loss. Then, to know the financial position of the business at the end of every year, to find out the amount of debtors and creditors, to find out the sources and application of funds, to prepare various accounts for future planning, to find out the value of goodwill for the purpose of reconstruction of firm, and to calculate various taxes of firm like income tax, etc. Now, we will come to the preparation of partnership final accounts. Actually, this final account is prepared with the help of trial balance and few adjustments. And these are very important in preparation of final account. The list of debit and credit balances of all ledger accounts is called as trial balance. The final account is prepared at the end of every financial year. Trading account shows the gross profit or gross loss, and profit or loss account shows the net profit or net loss of the firm. And the balance sheet shows the financial position of the business in the form of assets and liabilities at the end of year. Now we will see in detail what is trading account. Trading account is a nominal account. As we all must be knowing, what is nominal account? Debit all expenses and losses, credit all incomes and gains. Means here, under trading account, we debit all the expenses and we credit all the incomes. See, it is open in the trading organization for the purpose to find out the gross profit or gross loss incurred during the year. As I told you, in the debit side, all direct expenses are recorded, and on the credit side, all direct incomes of the firms are recorded. If the trading account's credit side is more than the debit side, then account shows the gross profit and vice versa. And the gross profit or loss is transferred to profit and loss account. According to J.R. Bartley, the trading account indicates the results of buying and selling of goods. While preparing this account, the general establishment charges are ignored and only the transactions related to goods are included. Now we will see the pro forma of trading account. Students, you should know whenever you are preparing, you should write DR as debit and CR for credit. Then prepare the six columns. On debit side 3 columns and on the credit side 3 columns. Particulars, amount rupees, then again particulars, amount rupees and amount rupees. First is the opening stock, and always write to on the debit side and buy on the credit side. See, the first is we will see the one by one. To opening stock, to purchases, less returns, to carriage inward, to freight charges, to dock charges, to custom duty, to wages, productive manufacturing wages, to wages and salaries. Here you have to remember the wages and salaries are given, means wages are given to laborers, and it is the direct expenses. That is why we are debited to this trading account. To import duty, to coal, coke, gas, power, oil, water, grease, etc. Then to royalty on purchase, to primary packing charges, to factory lighting and heating, factory rent and rates, factory insurance, to works manager salary. If you have observed, then there are direct expenses as well as the expenses related to factory. Then come to the credit side by sales. Sales is an income. Less returns by goods lost by fire, by goods lost by theft, by goods distributed as free samples, by goods lost in accident, and by goods withdrawn by partners. And the last is the by closing stock. Closing stock means the stock at the end of the year. And then if the debit side is more, then we get the gross loss, and if the credit side means income side is more, then obviously we get the gross profit, and that has to be returned in the debit side to gross profit carried down. Is that clear? Now we will proceed further to the profit and loss account. Like trading account, profit and loss account is also a nominal account. Only the difference is that under trading account we debited all direct expenses and credited all direct income. But here we are debiting indirect expenses and crediting indirect incomes. See, first is the two salaries and wages. Again remember that salaries are given to the office staff. It comes under the office and administrative expenses. And we debited wages and salaries to the trading account because wages are given to the laborers. This difference we have to remember. Then the rent and taxes, to insurance, to electricity lighting, to telephone postage, means telephone charges, to printing and stationery, to travelling expenses of salesmen, to depreciation on assets, to loading charges, to audit fees, to entertainment expenses, to repairs, renewals, maintenance, to interest on loan, to sundry miscellaneous expenses, to conveyance, to loss by fire, to loss by theft, loss in accident, to goods distributed as free sample. And remember, if the profit is there, then we have to credit to the profit and loss account. See here, the first item is the by gross profit brought on. And then the indirect income, that is the commission, discount received, interest received, dividend received, rent received, sundry miscellaneous expenses receipts. And if there is a sale of an asset and we get the profit, then obviously we should credit to the profit and loss account. Now, again there are certain expenses which are debited to the profit and loss account. To commission allowed, to discount allowed, allowances, advertisement, to carriage outward, to sales charges, to bad debts, to export duty, to taxes, to general expenses, trade expenses, legal charges, professional charges, bank charges, solicitors' fees, secondary packing charges. And if any fixed assets sold out and we incurred a loss, then that loss has to be debited to profit and loss account. And in the same way, like trading account, if the debit side is more, then we get the net loss, and if the credit side is more, that is income side is more, then we get the net profit, and that net profit is to be transferred to the partner's capital account or the current account. And now we will see how it is arrived in a balance sheet. See here, already I explained you what is balance sheet. Balance sheet is a statement of all the assets and liabilities, and which is prepared as on particular date, that is as on financial year 31st March. Now, as I told you that profit is to be transferred to the capital account. First we have to transfer the capital balances and then again add the profit, net profit. If loss is there, then we have to deduct the loss from the capital balances. Then come to the partner's current account, then reserves and surplus, that is the general reserve, profit and loss account. Then if any loan is taken, the loan on mortgage, bank loan, loan from partners, bills payable, bank overdraft, sundry creditors, and then discount on creditors, outstanding expenses. Now we must be knowing what are the outstanding expenses. The expenses which are payable but not paid. That also comes under the liabilities, income received in advance, provision for taxes, etc. And if we will come to the asset side, students remember that we have to bifurcate into three parts, that is the fixed assets, current assets and the fictitious assets. Under fixed assets, which items comes? Goodwill, land and building, less depreciation. And one more thing you have to remember, if there is depreciation, that is reduction in the value of the assets, then we have to deduct from that particular asset. Plant and machinery, less depreciation. Furniture and fixtures, less depreciation. Equipment, less depreciation. Motor van, less depreciation. Freehold premises, less depreciation. Patents, less depreciation. Loose tools, less depreciation. And then come to the investments part. Investment is there. Then stores and spare parts. And then come to the current assets. Prepaid expenses, outstanding income, loans and advances, closing stock, sundry debtors, now insurance claim receivable, bills receivable, cash in hand, cash at bank. And if here we have to remember that the balance sheet should get tally, means assets and liabilities should be equal. Then we can say that our problem is right if it gets tally. Then come to the important notes. Before solving the problem, we should understand and remember the important notes. Actually, this final account is prepared with the help of trial balance and few adjustments. Is that clear? Now, the number one, every item in the trial balance must be shown only one time and in just one part of the final accounts, excluding silent and hidden adjustments. Means for in easy way, I can tell you, trial balance gives only one effect and adjustment gives two effects. Every adjustment must have two effects in final accounts, that is debit and credit. We have already studied this topic in 11th standard as final accounts of proprietary concern, and most of the theory part, explanation of journal entries and effects of journal entries are similar. And to avoid repetition, common explanation is not given in the 12th standard, but explanation and journal entries of new adjustments are given. For common references, explanation teachers and students can refer the textbook of standard 11. Is that clear? Everything is given in the important note. And students, remember, if we want to tally our balance sheet, then you just go through and as well as write down this pro forma for 2-3 times. Again I am revising. Under trading account, we debit all direct expenses, credit direct income. Under profit and loss account, we debit indirect expenses and credit indirect income. And balance sheet is a statement of all assets and liabilities which should get tally at the end of the year. Okay, thank you very much.